Today, we need to talk about what's happening across the Atlantic and why it matters for your money. On October 14, 2025, European stock markets tumbled, sending shockwaves far beyond Paris or Berlin. When major markets get shaky, the effects ripple worldwide, even into your retirement account. The Stoxx 600 index hit a 2-week low, signaling that big investors are nervous and pulling out. Germany's DAX, France's CAC 40, and London's FTSE 100 all dropped about 1%. These aren't just numbers, they're signs of fear and uncertainty. Investor confidence is fragile. When it breaks, panic selling drives markets down. This wasn't random. It was a reaction to a mix of bad news, trade tensions, corporate warnings, and political uncertainty. Understanding these moves is key to protecting your finances. We'll break down the trade war, why Michelin's troubles matter, and what oil prices reveal about the global economy. By the end, you'll see how headlines from Europe can impact your financial future. Let's get smart about what's really moving the markets. The global economy is interconnected. What happens in Europe doesn't stay in Europe. Knowledge is power, especially when it comes to your money. Let's dive in. One of the biggest threats to the global economy is the ongoing US-China trade dispute. Europe's investors are watching closely. European companies rely on both markets. Recently, the US threatened new tariffs on Chinese goods, while China restricted exports of rare earth materials. Even after some softening, the damage to investor confidence was done. Trade war fears create constant anxiety, making investors less willing to take risks. Instead of buying stocks, they move money into safer assets like bonds or gold. The situation escalated when both countries imposed new port fees, raising shipping costs. These costs trickle down to businesses and consumers, squeezing profits and pushing stock prices lower. European companies, like German carmakers and French luxury brands, are directly affected. The global economy is a web. When one thread is pulled, the whole thing shakes. US-China tensions are a big reason European investors hit the sell button. They're bracing for slower global trade and lower profits. This is how a trade spat across the world can hit your wallet. The uncertainty is contagious, and markets hate uncertainty. Now, let's talk about Michelin, the French tire giant that rattled the market. Michelin slashed its profit outlook, blaming tough conditions in North America. Investors panicked. Michelin's stock plunged over 8% in a single day. This wasn't just about one company. Michelin is a bellwether for the auto industry. Its warning confirmed fears of a global slowdown, especially in autos. Fewer tire sales could mean fewer new cars sold, or people driving less. Both signal economic weakness. When people feel uncertain, they delay big purchases like cars. Michelin's bad news spread quickly, dragging down the entire auto sector. Investors worried that if Michelin was struggling, others would be too. One company's warning can trigger a wave of selling across an industry. The message, economic trouble in one corner, can quickly infect the whole market. For investors, it was a flashing red light. Confidence vanished, and the sell-off accelerated. When a giant like Michelin stumbles, the shockwaves hit the whole sector. Investors didn't wait for more bad news. They sold shares of other auto and parts companies immediately. Pirelli and Continental stocks dropped, even without their own warnings. This is the ripple effect. Fear spreads fast, punishing companies by association. Weakness in one company signals possible trouble for suppliers, car makers, and even raw material producers. The Stoxx 600 automobiles and parts index took a major hit, becoming one of the day's worst performers. This shows how sentiment, not just facts, drives markets. When fear takes hold, even healthy companies can get dragged down. It's a reminder. Your stock's value depends on its industry and the broader economy, not just company performance. The Michelin episode is a lesson in risk. Negative sentiment can spread like wildfire. That's why diversification matters. Don't put all your eggs in one basket, or even one industry. The market's reaction was swift and brutal. One company's stumble became everyone's problem. In investing, perception can be as powerful as reality. Stay alert to sector-wide risks. Oil prices also plunged the same day European stocks fell. Oil is a key indicator of global economic health. When demand drops, it signals trouble. Fears of a slowdown, fueled by trade wars and Michelin's warning, led traders to sell oil. Brent crude fell over 2% to around $62 a barrel. US oil dropped similarly. Lower oil prices can help some businesses, like airlines, but usually signal weak economic activity. For energy giants like Shell and BP, falling prices mean squeezed profits and lower stock prices. This drags down the entire market, creating a vicious cycle. Bad economic news pushes oil prices down, hurting energy companies, which then pull the market lower. Oil prices offer a quick snapshot of market sentiment. On this day, the message was clear. Brace for a slowdown. Investors grew even more anxious. The oil drop reinforced the market's negative mood. It was another sign the global engine was sputtering. The fear fed on itself. As if demand fears weren't enough, the International Energy Agency, IEA, released a report predicting a surge in oil supply. The IEA now expects global oil supply to rise by 3 million barrels per day in 2025, a huge jump. This increase comes from producers outside OPEC, adding to the glut. When supply rises and demand is weak, prices fall. The IEA forecasts a growing surplus into 2026, putting more downward pressure on prices. The report's subdued demand outlook spooked investors. A persistent surplus means oil prices could stay low for years. For energy investors, this was terrible news. It signaled long-term pain for oil and gas companies. The IEA's forecast poured gasoline on the oil market sell-off. The negative outlook added to the market's pessimism. Investors rushed to reduce risk. The IEA report also spotlighted OPEC+, the group of oil giants like Saudi Arabia and Russia. OPEC+ had tried to prop up prices by cutting production, but that discipline is fading. In September, global oil supply was 5.6 million barrels per day higher than a year ago, much of it from OPEC+. Some members are pumping more to boost revenue, ignoring previous agreements. This breakdown in cooperation adds uncertainty and risk. More oil is hitting the market just as demand weakens, a recipe for lower prices. The news of surging OPEC+ output accelerated the oil price drop. For European markets, this was another blow. Energy stocks fell further. Instability in oil markets makes investors nervous. Unpredictability is the enemy of confidence. The chaos pushed more investors to sell. Even on a bad day, some companies shine. Ericsson, the Swedish telecom giant, soared 14% while most stocks fell. The reason? Ericsson's quarterly earnings crushed expectations. This earnings beat showed its business was stronger than analysts thought. The global rollout of 5G technology is fueling Ericsson's growth. While Michelin's warning dragged down autos, Ericsson's good news lifted its stock. It's proof individual performance still matters, even in a fearful market. Strong companies in growth industries can thrive despite broader turmoil. For investors, it's a reminder to look for opportunities, even when headlines are grim. There are always winners if you know where to look. Political turmoil in France added another layer of uncertainty for European investors. The government faces two no-confidence motions. If either succeeds, France could plunge into crisis. Investors hate instability, especially in a major economy. A government collapse creates massive uncertainty about future policies. The CAC 40 was among the hardest-hit indices. President Macron faces calls to resign, deepening the crisis. Political chaos can stall reforms and damage confidence. On top of global worries, this homegrown risk spooked investors further. The result, a broad, sharp decline across European markets. When uncertainty piles up, investors sell first and ask questions later. On this day, fear won out, and few were willing to bet on a sunny outcome.